you all came out today, and I certainly appreciate it. This is some of the things that I could offer from maybe a traditional setting. Traditional institutions can't offer the account receivable financing, right? Basically, what this is that it was great about the account receivable financing. It's an off-balance sheet financing, okay? So essentially, what that means in a nutshell is that a lot of these, it's just like on a personal side, think about it. If you take out a loan, okay, that's considered a liability against you as it relates to your credit utilization in terms of your debt ratios and things like that. So, when you go to lenders, they see that and say, well, you have this amount of debt, you have that amount of debt. You may not qualify because we feel like you're a risk. You're kind of really what you call overextended or, high credit utilization. The account receivable is basically you can access a line of credit or a loan, okay, depending on what you're looking to do. And so how it works is that, and this is business to business, right? So this is good for like a government contractor. Actually, I'm working with Andre right now for a deal like this that we're going to get done. And
say that again.
Again, we're gonna get done, right? Yeah, we're gonna get done. We're gonna get that thing done. We're gonna get that thing done, right? Oh, yeah, absolutely.
Oh, and it's recorded.
It's recorded. Yeah, it's recorded. Exactly. That's a good one. So the great thing about this one is that they require at least invoices of $25K or more, right? So again, it's not for everyone, but this is a good option. So, for example, if you're a business, right? Okay, you're a government contractor. You have a contract with, maybe the Department of, the Navy Department or something like that. You can invoice, or you'll send them an invoice, okay? And if they say, well, we're going to pay you in let's say 90 days or 120 days, you're like, I kind of need the money sooner to operate and function. I can't wait 90 days. What happens is the lender will purchase the invoice, okay? And so at that particular time now, they're going to do their due diligence. They're going to check the account debtors in terms of how they make their payments. Are they good on their account payables and things like that? And so if everything works out and they've cleared that due diligence, essentially what the lenders do, they're going to advance the business owner up to 90% of what the invoice stated, okay? So we're using the receivables that you're going to get from that particular agency, okay, to help finance what you're currently doing. So really all we're doing is just giving you advance on the money that you're waiting on, okay? And so this is a great option. At least have 100K in revenue as long as you're 6 months in business. That's the great thing about this option is that, in a traditional setting, if you're not 2 years in business, if you don't have, a certain amount of we talked about the debt service coverage ratio, if you're not over that 1.2 threshold, if you're not profitable basically in the business at all, it's going to be very difficult to get any type of approval. This is a great option for a business, like I said, business to business. A lot of government contractors, or you're doing business with another entity, that we can look at the receivables and take advantage of it. Any questions around that?
How are they going to verify the invoice? Because I'm sure the government is not going to release that information, so how do they verify?
Well, again, they do their research on those particular organizations or companies. So they'll do the research. They have a mechanism that they'll do the research on it, and they'll look at the credit based on that particular company. Again, if it's a small unknown, they may ask for some additional information. We're going to look at the aging report and your receivable report. Have you done business? And also, too, that's a good question, Eric, is that they're going to see, have you done business with this business before as well? Okay, and if it's a federal agency, okay, it's they're willing to take that risk with their due diligence.
Yeah, so I guess the next thing on that same question is kind of like, let's say the government contracted out, the HHS, whatever, contracted out to you for a tech contract or whatever.
Okay.
And you have been doing it, but let's say now it's coming to an end, you have to rebid for that agreement. You're hoping you're going to get it. Would they, because you've been doing business with them, let's say for the past 6 years, will they use that?
Well, they're gonna base it off of what's current. They're gonna base it on so if they still owe you a receivable, they're gonna base it off of that. So we're not talking about future. We're talking about what's the current receivable now, and that's generally how they do it. They'll look at the timeline of if this is current, if this is a receivable within this certain time frame, we'll base it off of this here.
And you have to be in business for 6 months. Is that what that says?
Yeah, minimally 6 months. Minimum 6 months. Yeah.
Bernard, if I can add,
sure, go ahead.
To answer, I think Eric's question is, there's a lot of the information becomes public once the contract is awarded, not the details of the contract, but there are sites like USA Spending where a third party can go and verify the size of the contract, which agency you're doing it with, how long you've had the contract, so they could fairly easily verify if the invoice is substantial, yeah, if it's factual.
Thanks, right, appreciate it. Yeah, so this is a great solution. I mean, again, off balance, and I keep reiterating off balance because, you know, this doesn't impact you. You get this advancement from one of our lenders, and you can still qualify for a traditional loan. You know, you still can qualify. So it's not kind of against your ratios, like, oh man, you're overextended. We see you got an advancement here. This is kind of like an off-balance sheet loan. They're basing it off the assets of the receivable. And another solution, I know we're going to probably have it here as well, is it's adjacent to this. It's more of a higher end. It's called asset-based lending, and it's pretty much it's a line of credit. So this is pretty much like a term loan, and they'll advance you up to 90% of it. But
yeah,
go ahead.
So what I don't see here is the rates.
The rates, it's a good question. The rates will vary, okay? The rates vary. So for example, if they'll advance you up to 90% of the initial invoice within a certain time frame. And then if the account debtor doesn't pay within, let's say, 30 days, then it's like a 0.25 hit in terms of more interest on that particular deal. But I would say on average, this is anywhere between 8 to 10%, on these particular deals here. It varies, just lender specific though. It's a range, but I would say lender specific. I mean, at the end of the day, it's about margins, right? So they're not going to do anything that's going to impact the margins of the company. So from my experience, it's been very conservative as it relates to the rate. I mean, you really rarely see a rate over like 10 to 15%.
So someone that this will work for is they may have work orders in, they're supposed to produce certain things, but it's going to cost money to produce it, and they need the funds to get that out.
Exactly, right. They need the funds to operate and function until the money is coming in. So yes, they're looking at your receivables, right? They're looking at your IOUs, So, any questions? Questions around this? Good. We got the CPA in the house, so y'all get the taxes down. He can take care of y'all now. All right, consumer finance. So this is a great option. I have a client actually I'm working with this as well. Basically, this is business to consumer. This is for any organization that have really high margins. So let's say, for example, and it could be any type of industry, but let's just say, for example, someone who's like a business coach, like Andre. He's a business coach as well. And so, he has a fee, and, let's say, for example, that fee is broken down over a 12-month span, okay? Initially, you can't afford it right up front. It could be, who knows what the fee, let's just use a number, let's say $2,000, okay? You don't have that money at that time to pay for that whole amount. What we could do as a lender, we could essentially finance the services to you. Or basically, so what we'll do is the lender would advance Andre as his business, okay? And at this point now, the lender and the borrower will have a relationship, meaning that the borrower will now be paying the lender the finance for that particular service, okay? So it's great that you can still have your client, because your client may not have the funds all at once, okay? So they're gonna essentially act as a finance person to really help with that, in terms of getting the service or provide you affordability so you can access the service. I see the smirk. Okay, what's the
this
question?
is pretty new to me. So far, I kind of understand everything you're saying.
Okay.
So basically, he's a business coach.
Yeah.
I want his service. He's going to charge me $5,000 to do it.
Exactly.
I come to you. You're going to pretty much pay for the service.
If he can't, right, if you don't have, say for example, whatever financing you have in place or whatever his payments system is set up and you don't fit into that due to whatever reason it may be, okay, and you want to have the service, consumer finance allows you to still have the service through their financing. They'll advance him, okay? It's a great relationship for the business owner because he's going to get paid, right? And then in the event, let's say for example, you decide to default on it or something, the great thing about the business client now, all he has to do is have another person to replace, have another client that replace that particular contract or have someone that supplement that particular